Welcome, everyone. We're delighted that you're here. We all have busy schedules, so thanks for taking the time. Now, before we get started, we'd like to go over just a few housekeeping items. Many of you know this is our first webinar, so it's an experiment of sorts for us, and we hope to share some ideas with you that are both relevant and timely. Second, during the presentation, your phones are muted, but we want to encourage you to call us or email us if you have any questions or comments whatsoever, and we'll follow up with each of you individually. And finally, we're going to move through the material pretty quickly today. Our goal is to deliver some useful information to you in just under 30 minutes. So with that said, here's an important message from the lawyers and regulators, and then Dennis, if you'll kindly run through the agenda for today.
Can do. So today we'll give you a brief update on how markets across the globe have done this year. Then we'll cover a few of the headlines that have dominated the news recently and see what impact these have had, if any, by taking a look at the economic data and get a picture of how healthy our economy is. We've covered our investment philosophy overall quite a few times in kickoff events and halftime reports in the past, but Brian's going to take a little more detailed view on how we tilt the portfolios towards different factors and why we do that. Finally, I'll give you a look at our new website and a new secure client login page, which adds some cool new features we think you'll like. So here you see what markets across the globe have done through yesterday. And as you see, each of these asset classes has been positive for the year. U.S. stocks have increased over 16%. International stocks have increased about 8.5%. Emerging market stocks have not fared as well this year, but we're still up 2.5%. Real estate benefited from decreasing interest rates and had a really good year, up 17%. And bonds have done surprisingly well this year with the benchmark up 8%. So below here, below the arrows, you see our positions in each of these asset classes. And you'll notice that this year within the U.S. international emerging market stocks, we've underperformed slightly. And this is due to our tilts towards small caps and value stocks, which have not performed as well as larger growth stocks this year. So that's expected to happen from time to time, and Brian will cover why we have these tilts later. And you see with real estate, our DFA Global REIT has fared a little bit better than the benchmark, up about 1% more at 17.8. And our bond fund's done really well this year, outperforming the benchmark by over 3%. So that's what's happened so far this year. What do we see going forward? There could be two complete different versions of what we experience in the future. So the optimistic view would have major trade deals coming together, global growth picking up, U.S. economic growth continuing. A more pessimistic view would have tariffs hurting U.S. GDP, growth continuing to slow worldwide, and the U.S. entering a recession. So, of course, no one can predict exactly what combination of all these will happen in the future. What we can predict is that there will be a few headlines that will likely dominate the news going forward. So, of course, the first is the trade war with China. And then markets have recently priced in the additional tariffs imposed by Trump, which is one of the reasons we saw the large declines earlier this week. So if the U.S. backs off some of these tariffs, you'll likely see market increases similar to what happened earlier this year. And if additional tariffs are imposed again, we'll likely see markets decline. Are we going to make a bet either way? Definitely not. The second headline we will see often is news on the Fed stance and what's going to be happening with rates going forward. And we recently saw a 25 basis point cut, and the expectations we're going to have another 50 basis point cut before the end of the year. And here's the really important thing to remember is that all this news is already priced in the market. Even the 50 basis point rate cut in the future expected this year, that's already priced in. If you know about it, it's already too late. It's already priced in the market. So what moves markets is future news, which of course is unknown. And finally, the last one is, the election. I mean, just take a look at this headline from 4 years ago. All I can say is get ready for crazy headlines again. We're going to have to put up with more than a year of this. If you remember back 4 years ago at this time, the market was talking, all the headline was the market was going to crash at least 20% if Trump won the election. And of course, as we all know, that did not happen. So this is why we don't rely on short-term predictions and headlines to drive our investment decisions. We continue to look long-term, meaning 5+ years when we manage your money, and stick with our investment philosophy, stick with your plan. And so looking past these headlines, Brian's going to cover how our economy is doing.
Thanks, Dennis. So it's an interesting time we're in. It seems like we're just one tweet away from a big up day in the financial markets or a big down day in the financial markets. I've never actually done a tweet. 5 years ago, I didn't even know what a tweet was, but I thought we'd take a look at something that we know is important and we know is fundamental, and that is the labor and the job situation. So this slide really highlights the fact that the unemployment rate stands at right about 3.6%. This is the lowest level that we've seen in about a half a century. And the corollary to that is that 96% of anyone willing to work can get a job today. On top of that, total wages have risen about 4.5% in the past 12 months. So, this all indicates a tightening labor market rather than an economy that's stalling out. And in an economy that's still 68% driven by the American consumer, there's a lot to like about this picture here. And on the next slide are a few developments that pretty much made zero headlines in the mainstream media. At the left, you can see the balance sheet of the American consumer has really never been stronger, with assets exceeding liabilities by a ratio of 7-1. And at the same time, on the upper right here, you see JP Morgan reports that the household debt service ratio, debt payments as a percentage of disposable income, dropped to just under 10%, and that's the lowest level that it's been since 1980. I mean, I was a junior in high school, and that was a long time ago. And the lower right chart is the Fed's recent calculation that the household net worth in the United States of America recently rose above $110 trillion. It's the highest level that it's ever been. So the bottom line here is that the American consumer is working for higher wages. He's more confident in his job than he's been in a very long time, and he's more liquid than he's been in over 40 years. Again, in an economy that's 68% driven by the American consumer, this is all very positive. So between all the tweets and the news about trade wars and the global conflicts, Iran and the Federal Reserve raising interest rates or not raising interest or not lowering rates quick enough, and wild market swings, it's pretty easy to get knocked off course if you don't have a solid investment philosophy that you truly believe in. And as our friend David Booth likes to say, the most important thing about an investment philosophy is that you actually have one that you can stick with. And you may have already read our investment philosophy brochure, but there's an updated version of this important document. You can download it right after the webinar today at our website, alignmywealth.com. We think this piece does a pretty good job of explaining our strategy in plain English. And it's the game plan that we use to manage your money to withstand virtually any market environment that may be thrown our way. Bull market, bear market, everything in between. It's based on decades and decades of academic research. It's based on decades of our own experience in the trenches, and it helps us fulfill our obligation of doing the best job we can for you as your fiduciary financial advisor. So we'd encourage all of you to take a look at that and reach out to us with any questions or comments. As you know, we're always just a phone call or email away, and we're eager to help you. If we turn to the next slide, we're going to take a deeper dive into our investment philosophy today, especially on the stock side. So again, our investment strategy relies on decades of peer-reviewed academic research as applied by the leading pension plans in the world, which point the way to systematic differences in expected returns in different parts of the market. And we utilize these differences, which we call dimensions, when we can structure portfolios to target them and really add value for clients, really make money for clients after taxes and costs. So by their definition, dimensions of expected return are sensible. They are backed by robust empirical data and evidence. And importantly, they can be captured cost effectively in the real world for real people like you. In the stock markets, we have identified 4 dimensions of expected returns, and those would be the market premium, the size premium, the value premium, and the profitability premium. The market premium is simply the idea that we have preached over and over and over again for the past 26 to 28 years, that over long periods of time, and over long periods of time, the equity markets or the stock markets tend to outperform bonds or cash. The size premium has to do with the premium of small companies tend to outperform larger companies over long periods of time. The value premium, that's the way that Warren Buffett amassed his fortune, but value stocks, value companies tend to outperform growth companies, and the profitability premium is probably the easiest one for everyone to understand. Companies with higher profitability, that is pre-tax profitability, something that nerds like us called EBITDA, or title EBITDA, earnings before interest, taxes, depreciation, and amortization. But the profitability premium, higher profitability companies tend to outperform lower profitability companies. It's easy for most people to understand. If you go over to the next slide, and just please excuse me and bear with me. I know that this is a busy slide, but this is the empirical data that underpins the small cap, the value, and the profitability premiums. And what you see here is that each premium has appeared over many decades in the United States. And I'm not going to bore you with every one of these bar charts here, but if you will kind of move to the right, you can see that this is a worldwide phenomenon. It shows up not only in the United States, but internationally and in emerging markets as well. So you see, if you look over at the U.S. column, you see we got data going back 90 years showing that the small cap premium has been on the order of just north of 2 percentage points annualized for 90 years. And that may not sound like a lot, but if you've ever run a 2% difference out with like $100,000 on a financial calculator, that can result in a lot of money over time. Separate and distinct from that is the value premium. Again, this is the way that Warren Buffett has amassed his fortune, and it's not been in favor this year. But the value premium, here's 90 years worth of data that says that value stocks have outperformed growth stocks on the order of about 3.3 percentage points annualized for 90 years. Now, this year, Warren Buffett has not done so well. Value investing has not done so well. Warren Buffett's company, Berkshire Hathaway, has produced a negative 1.8% versus the S&P of about 15-16% year to date as of yesterday. Does that tell us that Warren Buffett has all of a sudden gotten stupid? I mean, nobody thinks that. His style is temporarily out of favor. Here's a lot of data that says that value investing is still a very viable strategy. We continue to utilize the value premium in our portfolios. And finally, the profitability premium. We've got roughly 55 years of data going back to 1964 showing that the profitability premium is on the order of just south, 3.98 percentage points, about 4% per year, going back for about 54, 55 years. Now, investing is all about risk and reward. And if there were no risk, there would be no reward. So these big premiums don't show up every year without fail. So on this next picture, what we see, this is a study of the premiums showing the frequency of positive premiums over any rolling period of time, 1 year, 5 year, and 10 years for as far back as we have data available. And as the time frame increases, you can see that the frequency of positive premiums increases as well for each one of these dimensions. So while the premiums are never guaranteed, they're much more likely to materialize and to make you money over and above the market the longer you stay invested. So however long you're thinking with your time horizon on your investments, think longer. We would encourage you to think longer, and it's much more likely that you'll enjoy a successful investment experience. Now, this picture right here looks at each premium individually, but what if you integrate all 4 premiums into a portfolio? And that's what we do in all of our managed portfolios. So a different viewpoint or a different approach is shown right here, where what we've done is calculate the frequency that 1 or 2 or 3 or 4 of these risk premiums were negative over rolling 10-year periods of time. And this is a study that went back to July of 1963 and covered the time frame from July of 1963 to 2018. So just think about that for a minute. You can kind of see the chart here. It resulted in total rolling 10-year periods of time, or total observations of 547 observations. And you just think about all the things that happened from 1963 to 2018. I mean, we've seen a lot over that period of time. I happen to have been born just a few months after that, but I mean, a lot of things happened between 1963 and 2018. We had Republicans, we had Democrats, we had low interest rates, we had high interest rates, we had a president impeached, we had good times, bad times, boom times, busts. More recently, we had the crash of 2008. We had the technology stock bubble burst. We had the housing crisis. I mean, this is a very varied, very long, and therefore pretty meaningful data set. And what we can see is, if you look at any one periods when any one premium was negative, like the most recent decade for value stocks occurred in almost half of the rolling 10-year periods. Dennis, if you can highlight that. If you had one of these negative premiums, roughly 49.4% of the time. However, the premiums don't move in lockstep, so there were relatively few instances where 2 negative premiums showed up, and virtually no instances where 3 or 4 negative premiums occurred. So this is strong evidence of why we utilize all 4 of these premiums: the equity premium, the small cap premium, the value premium, and the profitability premium in all of our managed portfolios. Dennis, this is all fine and dandy as far as academic research is concerned, but can you talk about how these strategies and these premiums have showed up with our actual managed portfolios for real people in the real world, please?
Sure can. So what you see here are our returns net of all fees through June 30th of this year, and net of all fees meaning net of our advisory fee, fund costs, trading costs, all of that. So these are just 4 of our more popular stock bond mixes. Many of you have slightly different allocations based on your own customized plan with this. But if you look over to the far left over here, you see the year-to-date numbers, again through June 30th. The S&P was up 18.5%, U.S. stocks. International stocks up 14.5%. So if you look at our 100% stock portfolio, right there in between, right where we would expect it to be. And then the 75% stocks are up a little over 12, 60% up about 11.5%, and one of our more conservative portfolios up 9% for the year. So if we go a little longer term, if we go over to the right over here, my fancy drawing, if we go back to the benchmarks, you see in that time frame, so this is beginning January 1st of 1999, the 20 years since then, it's annualized. S&P's done 5.5%, international stocks 3.2%. So if we compare stocks to stocks, our all equity portfolios outperformed the S&P by 2% a year, which may not sound like a lot, but Brian mentioned earlier, really adds up. If you look at the chart up here, the purple line, $1 million beginning in 1999, you're here. Our equity portfolio is, quite a bit higher, up a couple million there. So that 2% really adds up. And what we're really proud of is if you look at, let's say, for example, a 60-40 portfolio here, up 5.7%, that outperformed the S&P 500 with 40% less risk. So we're really proud of that we've been able to, outperform that with quite a bit less risk. And remember, these numbers include, I'm going to highlight 2000 to 2002 with the tech boom, crumbling down there. We had a really rough 3-year period. And then, of course, 2008. So we had two of the worst markets, in a generation within this. Those 4 years, that's 20% of the time right there. And we still had these returns over the 20-year period. So remember, we're not trying to beat the market. We're just making investment decisions based on, we're not making investment decisions based on recent news or headlines, but by sticking with our investment philosophy and paying attention to what matters and watching your portfolios every single day, looking for rebalancing opportunities when there's market volatility, and make sure that works in your favor. So as you see, based on these 20-year numbers, that's really paying off. Let me get rid of my drawings here. So the next thing is, as I mentioned earlier, we're updating our website, and we'll be rolling that out soon. We're expecting to roll that out fourth quarter of this year, and at the same time, we'll be rolling out an improved reporting system, adding some new tools for you guys. Here you see our new homepage, and what you'll simply be able to click on the client login up here in the right top corner. Once you click in and log in, this is what you'll see. I'm not going to cover everything on here, just kind of hit some of the highlights. But what you'll have is net worth, so we can do total assets and liabilities for your household. This is your total managed value that Align Wealth Management is managing for you. For clients that are not retired yet, what you'll see is a portfolio projection. This is based on your asset allocation and where you currently are. They'll show expected value of retirement and expected sustainable spending. And what it lets you do is go through and kind of, play with, what if I retire a year later, a couple years later, or earlier, or I save more, or I added some money in. You can recalculate that, and again, based on your asset allocation, it can rerun those projections and see what impact that has on your portfolio and on your plan going forward. For those of you who are already retired, it changes this, that instead of retirement age and monthly savings, it shows monthly spending, and then what's called investment horizon. If we have, if you're planning on living to 90, but you want to see what happens if you live to 95, we can make those adjustments, recalculate it, and see, what happens with your plan according to that. So for, for many of you, we've done much more detailed financial plans. This does not replace that by any means. This is, kind of a little more broad, where you can go in there and see, some of these impacts. If we scroll down the page, what you'll see is your current asset allocation, what you have in each asset class, and then the targets on what your investment policy is. Over to the left, you see returns since we started and year-to-date returns. And then what we also have is grading on diversification. Do we have your portfolio diversified properly? Are we keeping fund expenses low on the fund expense grade? And then the asset location grade, meaning do we have assets located correctly with the most tax-efficient investments in your taxable accounts and the least tax-efficient investments in accounts like your IRA or Roth IRA. So one of the things we've heard some people ask for is added into this link account button here on the left side of this is where you can go and add outside accounts. You can click on that, enter your username and password, and bring in things like your bank account or outside 401ks, really anything that has the username and password, to link it in here, and that way you can have everything, kind of your financial picture all in one login. And it's a secure login. We don't have access to go in and log in with that. We can't see anything. It just allows this each time you log in, it'll go update the balances. On the manual account, that's if you don't want to, or don't know your username or password, but you have a bank account maybe with $50,000, something, you can just click Add Manual Account, $50,000, and it'll update the net worth at the top of the page. So finally, you'll notice there's this button here, View Performance, and there's always this button over here, this pie chart. And if you click on that, this will look familiar. That brings you into your current, what you guys currently log into. So you still have access to this as well. So you can come into this, get more information on the portfolio performance, get a little more detailed information on contributions, withdrawals, things like that. And then up here, I wanted to highlight we've heard a lot of people don't see this reports up here. If you click on that, just to let you know, it'll bring up some other reports you can look at. You can look at more detailed account performance, holdings, summary of everything that's happened, with it, and transactions, really just everything that's happening in your account. It's an open book into our portfolio management system, all this is, but this shows every dividend and income, withdrawals, contributions, just anything that's happening every day, you can go out in there and see. And then finally, as you know, we send you out performance reports every 90 days. If you click on the Documents tab up here, that's where you can go and get the current one or any past performance reports that we sent out to you. But again, we're going to try to roll this out fourth quarter of this year. And before we do, we'll send out more information on how to log in, how to utilize the tools, all that information.
Good stuff. So thank you, Dennis, and thank everyone who took the time for being here today. We hope this has been useful and helpful. And remember, we're just a phone call or email away for any questions or comments. We're here to help. So thank you very much.
Thanks, everyone.